Hi CA students, let's revise here final AFM Advanced Capital Budgeting Decision. Problem 5. Project X and Project Y are under the evaluation of XY Co. The estimated cash flows and their probabilities are as below. They've given Project X initial investment which is 70 lakhs, and then probabilities for 3 years along with cash flows for 3 years. Then Project Y investment is 80 lakhs and probability weighted, and then annual cash flows through life. So this is throughout the life for project Y, and for project X for 3 years. The requirement of question is which project is better based on NPV and NPV criterion with a discount of 10%, and compute the standard deviation of the present value distribution and analyze the inherent risk of the projects. So first we'll calculate NPV. For calculating NPV, the procedure is simple as seen in the previous problems. We'll take the cash flow multiplied by the probability. Here for year 1 there are 3 probabilities and 3 cash flows. If we multiply the respective values with the probability, we'll get expected cash flow for year 1, then year 2 and year 3. Then we'll discount it with the 10% discount rate, and we'll get a expected net cash flow of 107, which we will reduce the initial investment of 70 lakhs, and we'll get a value of 37.28, which is positive NPV in case of project X. And for project Y, they have given annual cash flow through life, but since we have to compare project X and project Y, we will take this project Y for 3 years, then it will become comparable. So project Y for 3 years, first it's in this case the annual cash flow will be same throughout the life. So we have to multiply this cash flows with the probability. We'll arrive at a cash flow which is same for all the years. So in the second case we have to take annuity factor for 10% for 3 years, which will come up to 2.487, and multiplying that we'll get expected net cash flow 113.416 for 3 years, which we will reduce by the initial investment of 70 lakhs, and we'll get a NPV of 33.16. In this case also the NPV is positive. So based on NPV, project X is suitable because the returns are more in case of project X compared to project Y. Now coming to second part, compute the standard deviation of the present value distribution and analyze the inherent risk. So in both cases we have to check yearly standard deviations as we have seen in problem 1. So here we have the expected cash flow, which is 48.5 for year 1 and 41.5 for year 2, 38.5 for year 3. So this 48.5 we will reduce with respective years, respective probabilities 30, 50 and 65, and then square the difference with the probability, square the difference and multiply with the probability, and we will get a variance. So in case of first year it is 185.25, and second year 95.25, third year 35.25. Rooting this, square rooting this, we'll get standard deviation for yearly cash flows. Now as we have seen in problem 1, practical question 1, we have to get the standard deviation of the present value distribution. So how we'll get this? So we'll take the variance of years, then divided by discounting each year but multiply by 2. So for first year 1 into 2, second year 2 into 2, third year 3 into 2. So discounting in this way, we will get the standard deviation of the present value distribution 15.43 for project X. And for project Y, same way, we have the expected cash flow of 45.5, then reducing with the each cash flows and squaring it up, the difference, multiplying with the probability, then adding all, we'll get the variance, which is 12.25. Square rooting that, we'll get the standard deviation 3.5. Now in this case also we have to do the same way how we did for project X. The variance of yearly cash flows divided by the discount rates, but discount rates has to be multiplied by 2. So here we'll get a variance of 25.4 and the standard deviation is 5.03. Comparing the standard deviation of project X with the project Y, uh, project Y standard deviation is less, which means the risk is less in case of project Y. So project Y is acceptable. Thank you.